In this lecture, you will learn about the financial planning profession, the role of the financial planner, and planning competencies. By the end of this lesson, you should be able to discuss the role of a financial planner, explain the core financial planning competencies and how financial planning is both an art and a science, and describe the relationship between the financial planner and other financial specialists. What is financial planning? Here's an insightful definition by Dr. Rosalind Overton. Professional financial planning is the strategic management of a client's economic and financial resources to achieve the client's goals and objectives in a manner consistent with the client's values. A financial planner is concerned about all financial aspects of a client's life, not just insurance or just investments. The planner is concerned about knowing the client's attitudes, values, and priorities. In this financial planning program, you will learn core competencies necessary for helping your client achieve their goals. Personal financial planning emerged as a career in the 1970s. At that time, there wasn't really a clear body of knowledge or a standard of analysis that was consistently applied by all financial planning professionals. There wasn't a federal government, state government, or regulatory agency definition for financial planner, or a set of qualification standards for anyone representing themselves in this capacity. Thus, a plumber could hold themselves out or himself out to be a financial planner without doing anything financial. What started out as a vocation or a career for a handful of individuals is nearing international recognition as a profession for many. But one important trait of a profession is a body of written knowledge recognized by members of the profession that extend beyond that of a normal layperson. The medical profession has that. The legal profession has that. The financial planning profession is rapidly moving in this direction. There are several groups, associations, and titles supporting the over 400,000 individuals who call themselves financial planners. For this course, the definition and standards will be limited to the CFP Board of Standards, which owns the CFP name, and the Financial Planning Association, the FPA, which is one of the largest and most influential of the planning associations. As a financial planner, you should expect to wear many hats. Your roles in this career will range from advisor to problem solver to financial quarterback. Let's look at this slide for a moment. As a macro advisor, the planner views the client holistically, assessing their entire financial and life situation. As an advisor, educator, and counselor, you're helping your client move from where they are today to where they want to go in a manner they're willing to get there. Your role is extremely important because that road to financial security may not be traveled without your acumen and your guidance. As you educate your clients, they become empowered to take calculated but necessary risks. Your counseling is vital to keep the plan intact when clients resolve waivers in the face of market turbulence. As a problem solver and auditor, you analyze data to create a plan that's consistent with your client's goals and values. And then you keep that plan on track. Because of the breadth of financial knowledge, you serve your client as a financial quarterback, working with other professionals and coordinating plan implementation. To create the client's financial roadmap, you must be knowledgeable of core concepts listed on the following slide. In this introductory course, you'll learn in detail about the financial planning process, the regulatory and ethical environment, personal financial statements, cash and debt management strategies, funding for education, and planning for special client situations. You'll study intensely the 5 core planning areas: insurance, investments, income taxation, retirement, and estate planning in your other courses. And then you'll apply all that knowledge in synthesizing an integrative plan and writing and presenting a comprehensive financial plan during your capstone course. The client is always the person that needs to specify the goals. The financial planner may facilitate that process by asking questions and promoting inquiry. However, the client has to take the lead. Section 200-1 of the CFP Financial Planning Practice Standards addresses this topic. Goals become powerful drivers for action when they're written down, clear, with realistic targets, measurable, for example, save $1 million within 20 years, and consistent with the client's beliefs and values. That's why it's imperative that the client be as specific as possible in describing them. For example, retirement at age 65 is meaningless unless you know the lifestyle expectations, the monthly projected incomes and expenditures during that retirement period, the likelihood of health at that time, and obligations for postmortem gifting. Here's an example of a specific written goal. My son will go to a private college in New England for 4 years at my expense, starting 8 years from now. I will pay for tuition, books, room and board for the school year only, with nominal spending money and 2 trips a year back home. The goal specifies exactly when the schooling will begin, for how long, and what expenses will be incurred. The financial planner can easily project educational costs based on today's costs and the expected inflation rates. The investment portfolio can be set up and tracked to ensure that earnings and capital gains are sufficient to meet the future obligations. Funding the child's education is consistent here with the client's values. The table on this slide shows the results of a Wall Street Journal survey about financial goals. The results are ranked in terms of importance, with the most important being at the top of the table. The top 7 survey goals are: maintain existing lifestyle, increase current asset level, maintain current asset level, affording health care for the family, managing investment risks, protecting the estate from the impact of taxes, and protecting the family in the event of premature death. The remaining goals are described by the survey as: minimize income and capital gain tax, teaching children the value of money, leaving heirs an inheritance, managing debt, financing the children's education, and giving to charity. Notice how the opinions between people with an advisor and those without produce essentially the same rankings. Important planning objectives that you will work on when helping your clients include: maintain adequate liquidity, i.e. emergency funds, control personal use of debt, create a workable family budget, plan for future needs, manage catastrophic risk, and plan for the transfer of assets at time of death. Let's look at each of these in a little more detail. An emergency fund is designed to provide money for food, transportation, housing, and other basic living expenses during times when your normal source of income is disrupted. That might occur due to a decision to change jobs, falling seriously ill, or becoming temporarily disabled. With an adequate emergency fund, you don't have to disturb your financial plan by tapping resources that are positioned for long-term growth, such as a retirement account, an investment portfolio, the home. The benefit of having an emergency fund is you have a short-term safety net. The downside is that liquid assets such as money markets, checking accounts, and short-term certificates of deposit don't earn a lot of interest. To balance the benefits and drawbacks, emergency funds are typically limited to 3 to 6 months of living expenses. Those living expenses being fixed and variable fixed, non-discretionary expenses. So, if you currently need $5,000 per month in basic living expenses, then your emergency fund may be $15,000 to $30,000. The actual amount would depend on such things as whether or not you're married, if your spouse is employed, and the amount of time you would take to find gainful employment. Although all short-term debt is not necessarily bad, lack of control or excessive use is. Credit card debt is an easy source of money. However, there are serious drawbacks. The interest rates are extremely high, and you don't get to write off the interest against taxes. Clearly, one of the most important goals for anyone depending on credit cards to get by is to eliminate the short-term debt. In a later module, you will learn about cash and debt management strategies. Clearly, this is an area in which the financial planner can offer valuable advice. Clients have two things they can do with their income: consume or save. On one hand, the client wants to enjoy life today, while on the other hand, there's a need to save for tomorrow. A great goal for your client would be to pay themselves first. The first dollars from income always go to savings. A rule of thumb for savings is typically 5 to 10% of income. However, that would vary depending on your client's retirement goals and the employer retirement plan. As a financial planner, you can help your client commit to a systematic savings plan by showing them how much money can be accumulated over time. In a couple weeks, you'll learn more about cash flow management to generate systematic savings. Another important goal for your client must be to protect their estate against catastrophic loss. Liability lawsuits, flood, fire, and disability are just examples of events that could totally disrupt the financial plan if insurance is not in place. In reviewing your client's current plan, you would certainly focus on identifying any serious gaps in risk management. In the Risk Management Insurance course, you'll be introduced to the core concepts of risk management and insurance. At that time, you will discuss which risks might be retained, avoided, reduced, or transferred. Many people don't have a will, nor have they taken any actions to prevent intestacy, which means moving forward without a will. Why? Perhaps it's because people are reluctant to pay an attorney the cost of drawing up the will and the associated documents, or perhaps it's because they don't want to focus on something that brings up the idea of death. But the failure to complete this document is a serious shortcoming. As a financial planner, you will certainly want to eliminate the gap in the estate plan and make it a priority goal for your client. One way to motivate a client is to communicate to them that the will is a legal document that makes sure their transfer wishes are achieved at the time of death. It's also a way to eliminate arguments that might result among loved ones in the event that they pass without post-mortem directives. One way or another, the estate will be distributed, but the will makes sure that it happens in accordance with the client's wishes. In the estate planning course, you'll be introduced to estate planning and forms of ownership that pass assets outside of the probate process. Planning practitioners come to realize that financial planning is both an art and a science. The art of financial planning includes the ability to connect and relate to the client, communicate clearly and effectively in both oral and written formats, form long-term client-planner relationships, and recognize and name the client's emotions. The science of financial planning includes technical knowledge of products and strategies across the core planning areas, practical knowledge sets, the ability to think creatively and critically, and to move the pieces of the financial planning puzzle in combination. And knowledge of compliance rules and regulations. By combining the art and science with high personal ethics and values, you'll bring tremendous value to your clients and help a lot of families. Financial planners are normally considered to be financial generalists. Our broad knowledge base is necessary if we're going to serve our clients with comprehensive planning. But some aspects of planning implementation, like drawing up a legal trust or valuing a closely held business for estate valuation, will require the help of qualified specialists. Coordinating these activities with other professionals is usually the responsibility of the financial planner. That is where you assume the very important role of team leader or financial quarterback for your client. You should probably expect to be working with at least a tax accountant and a estate attorney, unless, of course, you already have acquired these specializations. This slide lists several other professionals that you might interface with on behalf of your client. Portfolio managers, risk management specialists, accountants and tax preparers, estate attorneys, retirement specialists, bankers and credit advisors, attorneys, real estate brokers, human resource department representatives, and possibly government agencies. Your relationship with these specialists should be one of mutual respect and purpose. You are both there to serve the client. In some cases, you're able to communicate and work with professionals that your client already has. In other cases, you may recommend your own network of competent, caring professionals. 3 valuable sources of information about financial planning profession are the CFP Board of Standards, the Financial Planning Association, or FPA, and the National Association of Personal Financial Advisors, or NAPFA. In this lesson, you learned about the role of a financial planner, the core financial planning competencies, how financial planning is both an art and a science, and the relationship between the financial planner and other financial specialists.